Hello everyone, Assalamu alaikum. Hussein Qazi here. Uh, this session is about the practice questions related to business valuation. So let's start some questions based on the lecture that I've already shared with you previously. So this is a question, NN company. What is the question about? The question is about calculate the value of equity value. As discussed in the last session, business valuation, two components, that equity valuation and debt valuation. Calculate the equity value of the NN company using the following business valuation methods: dividend growth model and net asset value. Now, this is the question. The following financial information refers to NN company current statement of financial position, assets, non-current assets, current assets, and the total assets value 143. Equity, ordinary share capital, preferential capital, retained earning. Do remember one thing, this preferential capital also mentioned in equity. It's by IFRS, but we are not here to discuss as a IFRS. This should be reflecting on the liability side. Total equity, non-current liability, long-term borrowings, current liabilities, total current liabilities, equity and liability. And next, the details. NN company has just paid a dividend. NN company has just paid a dividend of 66 cents per share. Cost of equity 12%. Dividend of the company grown in recent years, average growth rate of the 3%. Dividend growth. Ordinary shares, bonds redeemable 6 years, time at their par value $100. Current X interest, market price of the bonds 103. Preference shares of NN company have a nominal value of 50 cents per share and pay an annual dividend of 8%. Current ex-dividend market value preference shares 67 cents per share. NN company pays profit after tax annual rate 25% per year. Required, these are the requirement. Calculate the equity value, then calculate the after-tax cost of debts, then calculate the weighted average after-tax cost of capital of the NN company. Now, number one, equity valuation. How to calculate the equity value by DVM? It's very simple. P naught, current dividend, 1 plus growth divided by KE minus growth. It's very simple in this question. D naught is given, growth given, KE given, all these things are given. 66 cents, cost of equity 12%, growth rate 3%. So that is 0.66 multiplied by 1 plus growth 3% divided by KE, that is 12%. KE, that equals to 12% minus 3%, and the answer become $7. 55. Do remember, this is value per share. Now, the total value of equity. Company's number of equity shares. Here the question mentions that 50 cents par value. 100 million, 50 million total value. 50 million dollars divided by 0.5. 100 million shares. 7.55 into 100. That means total value of equity. Total value of equity 755 million, $55 million. That is what examiner asked you. Only calculated, no discussion. We will discuss later why this actual share price 7.55 different as compared to this 8.3, but later we will discuss later. Number two, candidates, for your knowledge, this is very important and relevant for the exam as well. Value of share by DVM shows fundamental or principal value of share or equity. This shows the fundamental principal value. Yes, the actual share price may differ from the principal and or fundamental value, but here is not the case about the discussion. It's simple how to calculate. That's the point. That's all. Number two, second important point, calculate the value of equity by net asset method. Net asset. Net asset method, it's very simple. Take out the book value of equity. Book value of equity. Book value of equity means take out the balance sheet and the total assets. The total assets is 143. Book value of total assets 143. Now what about the total liability? Liability. Number one, non-current liability 20. Current liability 29. And preference shares liability, that is 25. Although it's shown in the equity, but it's about the accounting. In the finance, the preference shares should be considered as liability. 25, 20, 29. 25, 20, 29. And that's equals to 74. Candidate, do remember one thing. This is the book value. Examiner can mention that there are some difference of the asset as compared to book value. What does it mean? The realized value of the total asset may differ from the book value. But if nothing is mentioned, we will assume that book value of total assets equals to market value of total assets. Both are equal. Book value total asset equal to market value total assets. If there are some adjustment, like if examiner says that in total assets there is a land, in total assets there is a land which have the market value $5 million more than the book value, then we have to adjust this 5 million add on here. Maybe the less one, it depends, but this is not the case. So 143 minus 74, it's equal to 69. And this shows the minimum. Do remember, this is what the net asset method. Net asset method shows the minimum value of any business. Minimum. And it's important for both acquirer and acquiree. Acquirer should have to know that what is the minimum value of the business. And acquiree also want to know what is my minimum value of the business. So dividend valuation model shows the fundamental value. Net asset method shows the minimum value of the business. This is all about this question for value. Now calculate B part. After tax KD. There are two debts here, preference share and non-current liability. Non-current liability mentioning the long-term borrowings, 7% bonds redeemable 6 years. Par value 100, X interest market price bonds 103. If particularly mentioned after tax KD, it's not means the preference shares. We will consider preference shares as a debts but with C part as a WACC. But here the cost of debts after tax particular about the long-term borrowing which is bonds. 7% bonds redeemable by IRR. Because it's marketable, redeemable, calculation should be based on IRR. That's KD post-tax. That's very simple. That's mentioned. I've already solved it. We have done already market value of bond with respect to investor. KD with respect to investor. Here 0, investor will invest 103.5, its market value. Return, coupon rate 7% apply on par value 7. Redemption 100. To discount rate 15%, 10%. That's 6.6 plus and here minus 16.6. And then calculate IRR. But this is KD but pre-tax. Post-tax KD. 6.21 minus 0.3. Sorry, 0.25. 6.42 into 0.75. That is 4.8%. 4.8%. This KD. That's the B part. And what about the C part? And C part related to WACC. 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 Candidates, as I already told you in my previous lecture that whenever you attempt to calculate the WACC, first of all identify how many financiers in the question. There are 3 financiers here. Equity, capital, preference shares and long-term borrowings. Bonds. Simple working for the WACC. No complications. Very simple. WACC E KD we have already calculated. Bonds KD by preference shares. PS preference shares. I'm sorry. ED bonds D preference shares. E very simple. In this case 100 million shares having a market value already given, that is 8.3. If this market value not given, then we can pick any, either DVM or net asset. Most preferable DVM as compared to net asset. Other methods may also use. But do remember, if actual market value given, then take out the actual market value, that is 8.3. That is 830 million. Bonds. How much total bonds here? 20. How much total preference shares here? 25. Bonds, par value 100, market value 103.5. Preference shares 50 cents, par value, market value 67 cents. Take out these matters. 20 long-term debts, par value 100, market value 103.5. 20 divided by 100, 103.5. 20.7. Preference shares 25 divided by 0.5 multiply by 6.7. Oh, sorry, 0.67. 25 divided by 0.5 into 0.67. 33.5. 830 plus 20.7 plus 33.5. That is 884.2. Now, another thing. What is KE? What is KD? What is KD here? Here we have calculated the KD 4.8 after tax. KE also already given in the question. KE already given in the question. 12%. Now here the KD with reference to preference shares need to calculate. It will consider irredeemable debts because time period is not mentioned. So KD is equal to dividend of preference shares divided by market value of preference shares. So preference shares dividend, it's very simple. Sorry, number one, market value 67 and preference shares is 8%. Nominal value 50 cents. So 8% into 0.5. 0.5 into 8%, that is 0.04. 0.04 divided by market value of preference shares is 0.67. 0.04, 0.67. 5.97%. 5.97%. We can put the figure as 6% as well. Now, WACC 12% into 830 divided by 884.2 plus bonds KD 4.8% already after tax. Yes, multiply by 20.7 divided by 884.2 plus preference shares 5.97%. You know very well that 5.97, that is preference shares dividend, it's not tax adjusted, so no tax adjustment. This 4.8 already tax adjusted into 33.5 divided by 884.2. Now calculate. The WACC has become 11.6%. 11.6%. So candidate, this is what a question. It's a question. It's a This video is about only one question, and wait for the another video for more questions related to business valuation. Thank you very much. Take care a lot. That's And do remember that we have done all the things related to that. That's simple. Calculate the equity value. That's we have done. Calculate the after tax cost of debts. That's we have already done. And last one is calculate the WACC with three different financiers: debts, bonds, debts, preference shares, and equity. Thank you very much. Take care a lot. Allah Hafiz.